Friends, do you know rupees 1 into lakh crore? That's how much money Indian retail investors have lost in the last decade by investing in companies without ever reading their balance sheet. A 2023 SEBI study found that 87% of retail investors, that's roughly 8 out of every 10 people trading on NSE and BSE, have never opened a single balance sheet before buying a stock. They look at stock tips on WhatsApp, they follow influencer portfolios, they chase green candles, but they skip the one document that could have warned them that Kingfisher Airlines was drowning in Rs 7,000 crore of debt before it collapsed. The same document that showed Yes Bank's assets were 40% overvalued before it crashed 85% in 2020. Here's what's wild. Reading a balance sheet takes exactly 15 minutes once you know what to look for. And today, I'm going to show you the exact 5 numbers that separate companies that will double your money from companies that will destroy it. The first number we're looking at has already made some investors 4,000% returns. Let's start with the left side of every balance sheet. Assets. This is everything the company owns that can generate money. Now here's where most people get confused. Assets are split into 2 categories: current assets and non-current assets. Current assets are things the company can convert to cash within 12 months. Think cash in bank, inventory sitting in warehouses, and money customers owe them, called receivables. Non-current assets are long-term holdings: factories, land, equipment, patents. Here's a real example. When you look at Reliance Industries' March 2024 balance sheet, their total assets are Rs 17.2 lakh crore. But here's the critical insight. Only Rs 2.8 lakh crore of that is current assets. The rest is locked in refineries, telecom towers, and retail stores. Why does this matter? Because if Reliance needed emergency cash tomorrow, they could only quickly access about 16% of their total assets. Now compare this to Infosys. Their March 2024 balance sheet shows Rs 1.4 lakh crore in total assets. But Rs 87,000 crore, that's 62%, is current assets, mostly cash and investments. This tells you Infosys has far more financial flexibility. The formula you need to remember is the current ratio. Current assets divided by current liabilities. Anything below 1.0 means the company might struggle to pay its short-term bills. The average current ratio for Nifty 50 companies is 1.4. Kingfisher Airlines in 2012, it was 0.3. They couldn't pay salaries, let alone survive. But assets only tell half the story. Because what a company owes, its liabilities, is where the real danger hides, and the next section reveals a debt trap that has destroyed 23 major Indian companies since 2018. Liabilities are what keep CFOs awake at night. This is everything the company owes to banks, bondholders, suppliers, employees, and the government. And just like assets, liabilities split into current and non-current. Current liabilities must be paid within 12 months. Short-term loans, supplier payments, upcoming tax bills. Non-current liabilities are long-term debts. 10-year bonds, bank loans stretching over decades. Here's where it gets dangerous. According to RBI data from Q4 2023, Indian companies collectively hold Rs 38 lakh crore in corporate debt. The companies that collapsed in the last 5 years, Jet Airways, DHFL, Reliance Communications, all shared one pattern. Their debt-to-equity ratio crossed 2.0 before they crashed. Debt to equity is simple. Total liabilities divided by shareholder equity. A ratio of 1.0 means the company owes exactly what it's worth. A ratio of 2.0 means it owes double. Most healthy Indian companies sit between 0.5 and 1.5. Let me show you a real comparison. Tata Steel's debt-to-equity ratio in March 2024 was 0.89, comfortable zone. But go back to 2015, it was 1.8 after the Crore acquisition, and the stock fell 60% over 3 years. Hindalco today sits at 0.76. Vedanta, 1.9. Now, I'm not saying high debt always means disaster. Reliance. Jio took on massive debt to build 4G infrastructure. Their debt to equity touched 1.4 in 2018. But they had Reliance's cash flows backing them. The key question you need to ask: can the company's profits comfortably pay the interest? This is called interest coverage ratio, EBIT divided by interest expenses. Below 2.0 is a red flag. DHFL's interest coverage dropped to 0.8 before it collapsed. But here's what most investors don't realize. There's a third section of the balance sheet that reveals whether you actually own anything valuable, and that's where your real returns come from. Shareholder equity is the section most people skip, but this is literally what you own. The formula is dead simple. Assets minus liabilities equals shareholder equity. If a company has Rs 100 crore in assets and Rs 60 crore in liabilities, shareholder equity is Rs 40 crore. This is also called book value or net worth. Now, here's where it gets interesting for stock picking. There's a metric called price to book ratio. Current stock price divided by book value per share. A PB below 1.0 means the stock is trading cheaper than the company's actual net worth. According to NSE data, the average PB ratio for Nifty 50 stocks is 3.2 as of March 2024. But here's a contrarian strategy that actually works. A 2022 study by ICICI Securities analyzed 15 years of BSE data and found that stocks with PB ratios between 0.8 and 1.5, combined with positive return on equity, outperformed the market by 4.3% annually. Let me break down shareholder equity further. It has three main parts: share capital, money originally invested by shareholders, reserves and surplus, accumulated profits the company kept instead of paying dividends, and retained earnings, profits reinvested into growth. When you look at HDFC Bank's balance sheet, their shareholder equity is Rs 347 lakh crore. But Rs 2.9 lakh crore of that is reserves, meaning they've consistently generated and kept profits for 30 years. Compare that to IS Bank before the crash. Their reserves started declining in 2018, down 23% year over year. That was a screaming red flag that most retail investors ignored. The metric that ties this together is return on equity, net profit divided by shareholder equity. It tells you how efficiently management uses your money to generate returns. Warren Buffett's rule: only invest in companies with consistent ROE above 15%. But even good numbers can lie. And in the next section, I'll reveal the 5 specific red flags that professional fund managers use to avoid 94% of stock market disasters. Here are the 5 red flags that have predicted 94% of Indian stock market collapses, according to a 2023 analysis by Kotak Institutional Equities. Red flag 1. Receivables growing faster than revenue. If a company's sales grew 10% but money owed by customers grew 40%, they might be booking fake sales. Satyam Computers showed this exact pattern. Receivables jumped 74%, while revenue grew only 21% before the fraud was exposed. Red flag 2. Inventory piling up. When inventory grows faster than sales, products aren't selling. Gitanjali Gems' inventory bloated to 287 days of sales before Nirav Modi fled the country. Healthy jewelry companies maintain 90 days. Red flag 3. Cash flow doesn't match profits. This is crucial. A company can show Rs 500 crore profit on paper but have negative cash flow from operations. How? Accounting tricks. Always compare net profit to cash flow from operations on the cash flow statement. If cash flow is consistently 30% lower than reported profit, something's wrong. Reliance Communications showed profits until 2017, but cash flows were negative for 4 straight years before. Red flag 4. Related party transactions exceeding 20% of revenue. This is when the company does business with entities owned by the same promoters. SEBI data shows companies with related party transactions above 20% have a 3x higher chance of governance issues. Check this in the notes to financial statements. Red flag 5. Pledged promoter shares above 50%. When promoters pledge their own shares as loan collateral, it signals desperation. Zee Entertainment's promoters had 99% shares pledged in 2019 before the stock crashed 70%. NSE provides this data for all listed companies. Write down these 5 checks. Run them on any stock you're considering. It takes 20 minutes and could save you lakhs. Now let me give you the exact free tools and step-by-step action plan to run this analysis on any Indian stock in under 15 minutes. Here's your exact action plan. Step 1. Go to screener.in. It's free and has balance sheet data for every NSE and BSE listed company. Type any company name, click balance sheet, and you'll see 10 years of data. Step 2. Check the 3 ratios we discussed. Current ratio should be above 1.2. Debt to equity should be below 1.5 for most industries, below 0.5 for IT companies. Return on equity should be consistently above 15% for 5 years. Step 3. Run the 5 red flag checks. Look at receivables growth versus revenue growth. Check inventory days. Compare cash flow from operations to net profit. Screener.in shows both. For related party transactions, download the annual report from BSE India website and search related party. It's always in note 38 or 39. For pledged shares, check NSE's corporate announcements section. Step 4. Cross-verify with Trendline or Tijori Finance. Both have free tiers with pre-calculated ratios. Remember, no single number tells the full story. The goal is building a checklist that filters out the bottom 20% of dangerous companies. That alone would have saved investors from Kingfisher, Satyam, Yes Bank, and DHFL. This is Fundamental Analysis 101. We have deeper videos on cash flow statements and income statement analysis that complete the picture. Subscribe to Wealth Pulse for weekly money breakdowns that actually build your wealth. The next video will reveal the 3 income statement ratios that predicted the last 10 multi-bagger stocks.